In an uncertain world for stock markets, what role for psychology when it comes to picking stocks? To help us think about these issues, we're joined by Jeremy Lang of Ardevora Asset Management. Hello, Jeremy. So I think in your investment process, you think a lot about normality. What is normal for investors and for managements who are making decisions about the companies they run? And to help us think about that, you've got a great chart here, I think, of the long-term oil price.
Right, so you see a lot of the bits of research that I read on the oil price only go back 20 or 30 years, and so they show, if you like, the tail end of that chart. And what you see on the tail end of that chart is that the oil price looks quite low compared to where it has been. But for me, what's much more interesting is where does the oil price normally sit and what causes it to spike and then slowly, because remember this is many, many decades of history, then claw its way back to, if you like, the more normal place that it is. And so for me, the most interesting thing about this chart is looking at what went on in the 1860s, 1880s compared to now, because that big oil price spike in the 1860s is what's called the Pennsylvania oil boom, and that was a period which, in my view, is very similar to what we have now. You had if you like, an exogenous shock which forced the oil price up, and then that triggered a huge change in behaviour in the people that run oil companies. There was this massive incentive to find new ways of finding oil in a cheaper way, and there was an enormous technological explosion. That's where oil drilling was invented.
And that brings us back to a very long period of very low oil prices, which should perhaps be normal.
That's right. That's our view, is that, if you like, there's a sort of feedback loop here. Once the price of oil gets very high, it then encourages this sort of systematic risk-taking in an industry where everybody herds and thinks there's lots of opportunity, but they behave myopically. And so a wave of capital comes in, which just, in the end, inexorably drives the oil price all the way back down again. And so that, for us, is the norm.
And so when it comes to investment, normality can also drive behaviour and risk-taking at companies as well. And I think you've got a chart here which shows some of that in Japan.
This chart here shows you balance sheet growth over a rolling 3-year period for a certain bunch of businesses, in this case, Japanese ones.
And what are the Japanese doing here? The exporters are getting a bit exuberant, is that the right word?
Yeah, so the story here really is, we kind of liked Japan back in 2011 because we felt that there were a lot of businesses in Japan that had been under the cosh for a long time, and so consequently management had sort of reined in their risk-taking. And so we were very careful with capital, and that's what you see in that chart in 2011. You see there's virtually no balance sheet growth over the previous three years for those export-led industries of autos and industrials. But as the yen moved and made it easier for those managers, their appetite for risk, if you like, started to rise. And so as we go through to 2012, 2013 and so on, you can see that their willingness to chase growth by investing capital slowly gets higher and higher, until now you see there's almost this explosion of commitment to capital for those export-orientating businesses.
Thank you very much, Jeremy.
Thank you.